welcome to the August Buy-to-Let Mortgage Market Update. My name is Richard Purnell. I'm from the Morgage Home and we are your buy-to-let mortgage experts. What have I got for you this month? Well, we've got 4 topics. As usual, we start off with Market Watch. And of course, we've got really exciting news. Yesterday, I'm recording this on the 2nd of August, so on the 1st of August, the Bank of England announced a 0.25% reduction. Yes, about time. What does that mean for you guys as landlords? So look at section 1 if you want to understand what that means for mortgages. Now then, in section 2, my headline here is, are fixed rates dead? Because look, if you believe that we're now on a downward trajectory with interest rates dropping, mortgage rates going to be dropping, why on earth would you get fixed rates? Well, listen in, because of some really fascinating insight as to what lenders are thinking and how they're planning and producing products when it comes to the options that you guys have. So you must check in on that chapter. Now, here's a question we get on a regular basis from you landlords, is how on earth do you buy an unmortgageable property? What do I mean by that? If it's a project property, if it's something that's dilapidated and a buy-to-let lender says, no, we ain't going to lend to allow you to purchase the property because we need rental income coming in and there's no way that that property is lettable at the point of purchase. What are your options? So if you're active in the market this year, looking to buy a property that might require improvement, conversion, then you must listen to that because there's some new innovation that's coming out with lenders and products right now. And finally, I'm always looking for ways of trying to keep money in your pocket, save you some money. And we've got another opportunity here. Now, particularly if you have stopped smoking or you're considering stopping smoking, or even you've got family members that have stopped smoking, and in conjunction with life insurance policies, there's potential for massive reductions in your premiums, which over months and years can turn into thousands of pounds worth of savings. So if you think that might be something you are eligible for or qualify because of the smoking situation, then just spend 5 minutes or so listening to that section because it just might save you thousands. Okay, let's get on with it. So in this piece, as always, it's Market Watch, and we've timed it really well. I'm recording this on the 2nd of August. Yesterday, the Bank of England finally, after 14 rate rises and then a whole year of plateauing at 5.25%, they came off the fence. We didn't know it was, we thought it was going to be close. I said it last month that don't be surprised if they held off yet another month. But they did come off the fence. Man, it was a close call. 5 votes to 4 in favour of reducing the Bank of England rate by 0.25%. We're now at 5%. So the floodgates opening, does that mean rates are going to drop month on month now? Well, sadly, I'm going to be a bit of a spoiler here and say no, my view is not. Look, we all know how prudent the Bank of England are. So yes, they've taken, by the narrowest of votes, a decision to drop rates yesterday. But of course, that clearly means there are still concerns. The underlying inflation figures, that's around service sector, and it's around food, and it's around pay inflation. These are still being really stubbornly at a higher rate. So hence, some of the committee voting to keep rates at the same place. So they're going to hold fire. Look, there's 3 more Bank of England meetings between now and the end of the year. My personal view is that next meeting in September, they'll hold it, and it will therefore possibly be at the November meeting that we'll see yet another reduction. So my view is between now and the end of the year, we'll have a total of a 0.5% reduction. So we'll be at 4.75 by December. So in terms of a mortgage rate forecast, and I said it on my last update in July, that lenders were just starting to reduce their rates, and that continued across every single bank, every single building society over the last 2, 3 or 4 weeks have been cutting rates by anything from 0.25 to Barclays were the most significant at a 0.7% reduction. So here's the thing. The rates you are seeing right now, if you're getting research sent to you, if you're looking on the websites of different lenders, the rates you're seeing today are pretty much the rates you're going to be getting for the next few months. Do not expect another 0.25% off your mortgage rates because of the decision yesterday. It's already happened. The lenders blinked first. They started reducing 2, 3, 4 weeks ago. So what you're going to see is what you're going to get. Look, of course, there's going to be a small amount of manoeuvring to either be at the top of the league tables or wherever they want to position themselves. But in terms of significant savings, you're already seeing those rate reductions starting to come through. So the takeaway message is nice and simple. If you have been sat on your hands, sat on the fence, now's the time to get off them, because the rates you're seeing are the rates we're going to get for the next few months. And I don't expect another rate cut and hence further savings on mortgages until well into the autumn. One last point before I end this section, and I have said it a few times. If you listen to me every month, you'll hear me say that although the overriding inflation figure is at 2%, we are expecting that high-level inflation figure to start to rise over the next month or two. It's planned, it's expected, it's not a shock to the Bank of England. It will not change anything I've just said. So don't let any of the social media or other commentators, when they see the overall inflation level start to rise slightly, that things are getting derailed. That is not the case. It is expected. It will drop again, and the Bank of England are expecting it, so it does not change their plans. In this section, I want to talk about fixed rates. My headline, a bit provocative. Are fixed rates now dead? Why am I saying that? Because look, yesterday, the 1st of August, we had the first announcement for over a year that rates are now dropping. 0.25% came off the base rate yesterday from 5.25 to 5. So if you believe that the trajectory now is a continued downward slope, and hence mortgage rates are going to also continue to fall, why on earth would you choose a fixed rate? Surely you'll be thinking, well, I want to take advantage of the ongoing savings and reductions that are going to happen over the coming months and into 2025. You would therefore lean towards a tracker or a discounted variable so that you could get the advantage of those savings as they came through. And of course, a fixed rate gives you some certainty about rates, but you ain't going to get those benefits. So the question is, well, surely you will then be looking at the discounted variables and the trackers. But here's the thing. I did some research yesterday, and what I put into the search engine was a really vanilla, straightforward, simple inquiry for a landlord who wants to borrow 75% loan to value on a standard buy-to-let with absolutely no issues, really strong rent. In other words, a type of inquiry that every single buy-to-let lender would want to lend against. We got over 2,000 products coming up as meeting those requirements. But here's the kicker. 95% of those products, that's 1,958 of the 2,000, just over 2,000 products were fixed rates. And we only had 94, that's 5%, were either trackers or discounted variables. In other words, the lenders are really skewing the picture. They're really dictating what's out there. They want certainty. They want you still to have fixed rates. Yet I think that landlords should be asking for and demanding to have on the table trackers and discounted variables to compare against the fixed rates. And right now, as I said, it really is slim pickings. However, let's still get under the surface, because have a look at these two products. This is a market-leading variable discount rate that's out there right now today at 5.69. And below that is the market-leading 2-year fixed rate at 5.09%. As you can see, valuation fees pretty similar. The product fees are 0 in both cases. So we really are just looking at the headline rate, and they both are asking for commitments for 2 years. So as you can see, the variable discount is 0.6% higher than the fixed rate. So here's the thing. If you are really positive, glass half full, if you think that the mortgage rates are going to be dropping quite aggressively over the next 2 years, then I think you're going to lean to a variable discount. Even though it's 0.6% higher right now, there is still that initial 0.25% to filter through to that already, plus whatever's to come in the end of the year. I've said earlier that I expect another 0.25% before we hit December, and of course further reductions into next year. So if you are optimistic that that is going to continue, then you might want to take the discount rate and bag those savings as they come through, because you think that they will get really into the low fours, maybe in a year's time, and you'll overall benefit from the savings, even though right now you're paying a 0.6% premium. If you're more level view, or indeed a glass half empty, if you think the Bank of England will be dragging their heels and that there'll be a very, very prudent approach, then I suspect you're more likely to still favour a 2-year fixed at 5.09%. Now, an extra thing I really want to, a couple of points actually I want to make before I finish. First of all, if you are leaning towards the variable discount, it is not guaranteed that the lender will drop rates just because the Bank of England rate drops. Look, there's 2 types of variable rate. There's a tracker and there is the variable rate. Now, the tracker quite often tracks the Bank of England rate, which means there's an absolute direct connection and link to if the Bank of England rate drops, then it is guaranteed that the lender will pass that full saving on to you if you have that Bank of England tracker. But there are also trackers that track an internal variable rate, and this variable discount is one of that type. In other words, the lender can choose whether to pass on all of the saving, some of the saving, or indeed no savings at all. So bear that in mind. Now, it would be unusual if a lender did not pass on that savings, by the way. But all I want to make the point is it is not guaranteed. So bear that in mind if you are leaning towards a variable discount. Check with your broker. Is it actually linked directly to the Bank of England tracker? And there you'll know. And if it's not, then there is another decision to be made. The last point I want to make on this section is, what about 5-year fix? Well, look, if you are active in the market, if you are building your portfolio and you are relying on the capital growth in your properties to access the equity increase over time, then I think you'll probably want a 2-year fixed anyway, so that you have that full opportunity to review your portfolio and therefore access the equity after the 2 years are up, because there's no penalties, no issues. If you take a 5-year fix, there's possibilities you could access any equity growth, but it's a lot harder. You've got limited choices. If you're not looking to grow your portfolio, not looking to access any more equity, you just want stability, then right now lenders are still pricing 5-year fix lower than the 2 years. They want you to take a 5-year fix. Just having a quick look yesterday, you can get a 5-year fix at 3.99. Now, you might go, that's fantastic, but it does come with a fee. It's a 3% fee. Now, I've put it on this slide here. So if you take that 3% fee, because it's a 5-year fix, divide it by 5, which is 0.6%, and add the 0.6 to your 3.99, then you get, well, actually, I've done a miscalculation. It's 4.59, not 4.69. Apologies for that. So you get an actual, your rate that you're looking at is 4.59. And if we go to that earlier slide, the 2-year is 5.09. So you can see that the lenders are still trying to entice you. They're dangling that carrot to take the 5-year fix, because it's been priced slightly lower than the 2-year deals right now. So it's still not a clear-cut conversation or decision. So if you do want to have a conversation with the brokers, there is a link below this piece to our diary. Just book some time in, have a chat, no obligation. We'll give you all your options that are based on you. Obviously, what I'm talking about today is really generic, so please don't rely on it that it's the best product for your situation. You've heard me say this before. Talk to the brokers. They'll get your full chapter and verse about your situation and then tell you what's out there. In this piece, I want to talk about unmortgageable properties. What do I mean? Let's start off with a definition of an unmortgageable property. So this is one you're looking to purchase. And it will be dilapidated. It will require conversion. It will require some sort of renovation. Perhaps you are converting basements, attics. You are knocking out all the internal walls to create more bedroom space. Maybe there's planning permission changes are required. So it's something of that nature which a lender says, we ain't going to give you a buy-to-let mortgage on it, simply because that the day you get the keys, you can't let it out, you can't get rental income in, and therefore a lender is actually approving a mortgage on the basis that there's rental income to pay the mortgage. So if they can't see that you are in a position pretty much straight away, they allow for some cosmetic work, but anything more significant, you ain't getting a buy-to-let mortgage. Now, the first two options, I'm just quickly going to cover off. Great if you can buy cash, if you've got deep pockets, or you've got a joint venture partner who can put the money in. Get on with it, go and buy that property. You're buying it for cash, you're in a strong position. Great, you can negotiate really strong and hard and hopefully get some great discounts. Another option, lesser known, and you may not have thought about this, and if not, make some notes now and go off and do some research about lease purchase options. There's a lot of content out there. There's a lot of education companies that are offering training on this area. So if you don't know about it, it's a fantastic option to have up your sleeve, whereby you don't buy the property right now, but you take control of it. And that will allow you to get the cash flow in, and also you have that written contract with an option to potentially buy the property in the future. And that might give you time to organise the cash to buy it over the next 1, 2, 5, 10 years, whatever that contract or that option says. Anyway, today I want to talk about bridge to let lenders. Now, slightly more involved than just bridging finance. I've talked about bridging before, and if you've never really looked into it, then look back at my March 2023 video update, and I did a section in there specifically on bridging. So that gets under the surface about that. I'm not going to talk about bridging per se today, but this is something, it's like a sister product to bridging called Bridge to Let. Okay, what is it? Well, it's a two-part product. So yes, it's bridging to start with. So it allows you to purchase the property with finance. So in simple terms, you're putting in possibly 25% of your cash deposit, and then you're getting short-term finance for the other 75%. That gets you the keys, that gets you in the property, that secures it. Then you're going to do the renovation, the conversion, the change of use, whatever it is that stopped you getting a mortgage in the first place on a traditional basis. You do that piece of work. When that work's done, you go back to the exact same lender who's expecting you to come back. Because at the point of application, you've given them a schedule of works of what's required to do that renovation, that conversion. And you've told them what you think the uplift of valuation is going to be. So they've given you two mortgage offers, one for the purchase and another one on the basis of an uplifted valuation and the work's been done. Of course, do they trust you? No, they don't. They send the valuer back out. They check the work. They check that it's done to the right standard. They then agree, or otherwise, with the uplifting valuation, and then they'll issue the revised offer based on those figures and release the money accordingly. Now, the fantastic thing that this gives to you guys, you will have heard of, and if you haven't, I'll explain what I mean by a no money down deal. Now, yes, you're putting money down to start with, but there's no money left in the deal at the end of the project. So if I'm just going to flick to my next slide, what we've got here is a scenario that's not untypical. And I've kept it simple, and I know there's other costs to think about, but for simplicity, just follow the numbers. And you might want to jot these down. We're buying at 100,000 in this example. You've put cash of £25,000 in. The renovations, the improvements cost another 25,000. So it's now cost you 50,000 quid. But the property, when all the works are done, has gone up to 156,000. That's an interesting figure, you might say. Where's 156? Well, it's just so my maths work out. Because if you take 80%, and by the way, these lenders will allow you to borrow 80% loan to value, then that equates to 125,000. And guess what? Magically, that means you can borrow another 50,000 over and above the original bridging, because you will have borrowed 75,000 to start with of the 100k purchase. Now you're borrowing 125. There's the extra 50. Oh, what did we borrow? What did we put in cash to start with? 2 lots of 25. You've got your money back out. So in simple terms, that allows you to get all your money back in your pocket. Yes, I know there's other fees and stamp duty. I get that. But then essentially you can move on and repeat that formula. So if that is your strategy and you're looking to grow your portfolio quickly, this is an unbelievable product that really helps you to do that and move at a quicker pace. So, as I said, it allows you to get your ducks lined up. You're going to one lender, one underwriter, knows what you're looking to do, is happy with what you're looking to do, and puts the mortgage offers in place so that when you're putting your offer in right at the start of the whole chain, you've got certainty that the mortgage finance is going to be lined up. You know what the interest rates are going to be. You know what the products are going to be. You know what the costs are going to be. And that's before you put an offer in. So you know whether it's going to make sense for you financially, whether it's going to stack up financially and give you your return on investment before you actually get your offer accepted. So the takeaway message is, if that is you, if that is your strategy and you're looking at that type of property this year, then, and you don't have a broker that specialises in this area, then look, there's a link below this piece. Click on it, book some time in with the team. If you have a property in mind, send us a link to that property so we can have a look at it. You never know, it might be mortgageable. Okay, we're not experts, we're not surveyors, but we have a working knowledge in this area. We might be able to say, do you know what, we think it is mortgageable. We might be able to send that detail to potential lenders, and they sometimes have in-house valuers that can have a look at it and say, do you know what, we think it's mortgageable. And therefore you don't even need to go through this process, which will save you time and money. But if it's not, and you need this two-step strategy, then talk to us at the earliest opportunity. Send us links through, as I said, to the property, and we'll do the research, give you the numbers, and you can make some decisions with some certainty. Hope that's been of use. In this piece, I want to talk about saving money. Who don't want to save money? Come on, put your hands up. Of course you do. There's never a bad time to save money, and this is around insurance. From time to time, again, if you watch my updates on a regular basis, I'm always looking, particularly around insurance, at opportunities to, save money on your premiums, because you're paying those premiums when it comes to life insurance, which is what I want to talk about today. You're saving money. Okay, it might be 10 or 20 quid a month, but if you could save 20 quid a month, your life insurance normally would be for 25 years. You're mirroring the length of your mortgage. So 25 quid a month could be £6,000. I don't know if I've done the maths here, but it's thousands and thousands of pounds of savings over the longer term. So do not turn your nose up if you can save 20 quid a month right now because of the cumulative effect. So where's the saving opportunity this month? Well, it's around smoking. Now, let me just rewind a little bit. If you came to me today and said, Richard, get me a quote for life insurance, and I say the premium is £40 a month, and you say, oh, sorry, I forgot to tell you, actually, I'm a smoker. Then I would go back and I would say, well, do you know what, that £40 a month premium that I thought as a non-smoker increases by about 50%. You're now at £60 a month. An extra 50% on your premium. So, here's the thing where the saving comes in. Because if you've quit in the last year, at least 12 months ago, then lenders will reassess you as a non-smoker. Yes, you've got to not even be vaping or on patches. You've got to have quit properly. Now, you might say, hold on, Richard, how is an underwriter or at the insurance company going to check whether it's been 10 months, 11 months, 12 months? And you're absolutely right. There's no hard and fast way of checking whether that 12 months are up. So there is a degree of uncertainty from the insurance companies. They will ask you, as the applicant, to state that there's been a 12 months hiatus between stopping smoking and today. So there is an amount of trust going on here with the life insurance companies. Now, what they may do, and I underline may, is that they might actually get you to undertake a nicotine test, and they will check to see your nicotine levels from perhaps a blood test to see whether you will be classed as a non-smoker. So you need to bear that in mind. You need to do it legitimately. You need to have stopped smoking. And so when those tests are done, you've got that clear way forward, and the underwriters and the insurance companies will stamp you off as a non-smoker and put you onto those lower premiums. So even if you've got a policy right now, you've taken it out as a non-smoker, you're not committed to any insurance company. Unlike mortgages, there's no redemption penalties. There's no minimum period. You've got to have this policy. You can take one out today, cancel it tomorrow without any cancellation fees at all. And then we can put you with the right insurance company as a non-smoker and get those savings. So if you think you might qualify, has that been the incentive that you need to quit smoking? So maybe you're thinking, well, I'll quit and I'll come back in a year's time. Fantastic. I really hope that that's been the little nudge that you've needed to quit smoking. You'll be following in a well-trodden path here. Since 2011, over 3 million UK adults have quit smoking. So I'm really thinking I should be talking to a few people here today, or if not you, is it family members, is it friends that you know have made that great step to quit smoking? And if they are adults, they're homeowners, they probably have got some sort of life insurance. So it's worth passing on that bit of good news. Get them to have a look. Did they take the life insurance out when they were a smoker? Because do you know what? When you quit smoking, there's no way that you make the direct connection between the great news of quitting smoking and all the health benefits it brings, and someone goes, oh, must check my life insurance. It's unlikely that's going to happen. So I can see thousands and thousands of people that have got life insurance that are now overpaying because they never made the connection back to their life insurance policy, and they're still paying premiums as a smoker because they don't realise, and they also don't know that they can get it reassessed now as a non-smoker. So I really, really, really hope that resonates with quite a few of you. And if you want to have a chat through with our insurance advisor, there'll be a link at the end of this piece. Have a conversation, see if you qualify, and I really hope that you make some savings. And if you do, put some comment in below. I'd really hope to hear that good news. Thanks so much for listening. And just for to finish off now, there's the address for the link to our diary. But again, for simplicity, it should be below this video. So just click the link. But if you want it for later, take a little screenshot so you keep hold of it. If you want to make an appointment, if it's not convenient right now. If you want to ring the office about something more complex, if you don't want to make an appointment or want to chat with someone, then give the office a ring. Oh, look, if you're watching this for the first time and you've never heard of us before, then there's our website address. You might want to look into us by all means, and get to, do your due diligence on us. There'll be a few testimonials on there as well. So you're more than welcome to that. Other than that, thank you so much for watching to the end. Really, really do appreciate that. If you've got any observations, any comments about anything I've talked about today, please put it on the comments below. Ask your questions below, and I log in every now and again, and I'll answer those questions and comments. But other than that, thank you for watching, and have a great rest of the month.